Okay, we are live here with Lyn Alden, someone who I think puts together the best macroeconomic analysis that I come across. And I'm a geek with this stuff, Lyn. I read a lot of this stuff, but your stuff, and specifically the charts that you put together with your analysis, are just incredible. So I want to start with that, and I'm going to dive in with one of the charts. You were the first person that I read that really zoned in on the 1940s comparison. And you have this wonderful chart where you show when a government, and in this case, the US, gets a debt to GDP that's over 100%, maybe touches 120, that in the past, if we use history as a guide, central banks will keep rates really low, often or in that period for a whole decade. And that the intent with that, if I'm understanding correctly, was to bring the GDP down or inflate the economy. So as a percentage against the economy, the debt was less. And it looks like we're doing that again right now.
Yeah, everybody learns from someone else. And so I originally came across analysis by Ray Dalio years and years ago, because my research was aiming at, okay, so we're building more and more debt in the system. How does this end? What are the different end games for this particular cycle? Not the end of history, but the end of this, period of time. And I found that he had the most kind of complete explanation. And so I eventually looked at that thesis and then said, well, let me dig into the numbers myself and see if I can reconstruct it and see if I can look at it from other angles, right? So kind of inspired by one thing and then try to add value to it. And so all of my research kept pointing in that same direction, where you go through these periods of long-term debt cycles. So you build up, you have the short-term credit cycle, you build up debt in the system, then you get some sort of event or some sort of, say, monetary tightening cycle that kind of washes it out. You get a period of partial deleveraging, but then you start building up debt again. And you never go back to your baseline. Instead of a sine wave of debt that goes sideways, it's like an upward trending sine wave. And so you get higher and higher debt as a percentage of GDP and lower interest rates until you hit zero interest rates or even slightly negative, and you get extraordinarily high debt levels. And historically in history, when you hit that sort of period, you get basically currency devaluation, debt monetization, and financial oppression, which is basically that you start to get large fiscal expenditures and they hold interest rates low. And so you get pretty high inflation, pretty high nominal GDP growth because the large inflation component, while they're holding debt well below the inflation rate. And so because basically if you have 100% or 150% debt to GDP, if you do the math on interest rates, you can't really have structurally positive real interest rates. And so you get that period of financial oppression. And then if you tie it even back to longer cycles of just kind of like debt jubilees or wealth concentration cycles that literally you can evidence that back thousands of years to ancient Greece and the Near East, humans just go in these big cycles. And so my kind of research has been based on the idea that we are in one of these cycles and that most people looking at 20, 30, 40-year back tests are kind of missing the bigger picture. And I think that's starting to become more apparent, but it's something that I've been focusing on for about 2 years now.
And I think what made it even more apparent recently is now we have a kinetic war going on that you also referenced, because I remember reading your material thinking, okay, there's a lot of parallels here, but there was also World War II. And not that discredited that type of analysis, but now that we actually have a shooting war going on, it's like, the realization is like, holy smokes, like how similar are we to that particular era? So I guess my question for you is 10 years from now, where are we? Like forget the next year, like 10 years from today, like if I'm a Canadian sitting here in the Toronto area, thinking just from my family, like where are we when it comes to stuff like currencies? Like where are we? Where is the Canadian dollar, the US dollar's role, the Canadian 10 years from today? What do you see?
So there's that old quote that history doesn't repeat, but it rhymes, right? So my point with the 1940s is not that we're going through an identical period, but that it's the closest period that we should be familiar with. If we're basically things that seem shocking are less shocking in financial markets to you if you are familiar with the 1940s. You're like, oh, it's kind of like what happened there. And so it's basically the closest template we have. And then the question becomes, how do we differ from that template? What are the differences? Because it's not identical. And one example is that back then, the United States was running structural trade surpluses. And the UK, the existing power at the time, was the one running structural trade deficits. And so now, in many ways, the United States more resembles the UK from the 1940s, where they're the leading power, and they have the structural trade deficit against a rising power, which back then was the United States, and now is China. And that doesn't mean it's going to follow the same exact pattern. There's obviously different geographic differences. There's all sorts of differences there, but there is kind of a semblance there. And generally, what I was seeing was I wasn't talking about kinetic war, but I was talking about essentially wartime finance, where back then you had very large fiscal expenditures that were monetized, and it was very inflationary and it was very commodity heavy. And what we were seeing in response to a pandemic hitting a highly leveraged system, right? Because humanity's had pandemics in the past, and if you don't have a lot of leverage, it's not that it's obviously still bad from a humanitarian standpoint, but from a financial standpoint, it's not the end of the world. But if the whole system's so tightly geared and there's so much operational leverage and financial leverage that it can't absorb shocks, right? It could be anything. It could be a natural disaster. It could be a virus. Could be a war. If something hits a system that levered, you get these. Basically, the system cannot let itself collapse. Credit markets are based on always expanding, and that's why these kind of recessions have gotten kind of shorter and crazier with bigger and bigger government responses. And so when you're kind of at the long-term debt cycle, you're already at the zero bound in terms of monetary policy, and you get a big shock to the system, you get a massive fiscal response. And so it looked like wartime finance, even though we weren't in a kinetic war with another country. We were at war with, biology, essentially. We were at war with just saving our leveraged system. And I was hoping that it wouldn't turn into an actual kinetic war. But the other thing I was looking at was, so I'm quantitative. I focus more on the quantitative side, but I also pay attention to the qualitative side. And so, for example, there's a book called The Fourth Turning, where they look at cycles from a demographic standpoint. It's his two historian demographers wrote that, and there's some aspects that seem, you could say it's wishy-washy, but it becomes more interesting when you say that. So their argument is that every roughly 80 years, you have kind of a generational crisis where prior institutions get torn down, new institutions get built, the social contract gets destroyed and renewed, and it could be good or bad. I mean, you could replace a decent social contract with a worse social contract, or you could build something better. And what I noticed was that all of his, quote unquote, fourth turnings, his crisis standpoints coincide with long-term debt cycles, right? So basically, in all those long-term debt cycles where you get kind of a big shift in monetary policy, you also have rising populism and things like that. And so it's not surprising that you get wars in those periods. And basically, those wars are kind of the catalyst. And, I was hoping that this period would be one without a kinetic war, and that it would be purely kind of, humans versus nature or humans versus their own leverage, essentially. But now, yeah, we're throwing kinetic war into the mix, and so it's unfortunately even closer to the 1940s. And now I would say hopefully the war doesn't get anywhere near the scale as it was in the 1940s. But you do have you have protectionism, you have increasing geopolitical contact after a period of relative harmony, and you have a highly leveraged system. So in many ways, it just continues to resemble the 40s, closer than I could have imagined.